You have been lied to. Not with words, not with a contract clause buried in fine print. You have been lied to through a system so normalized, so widely accepted that most people never even question it. And the worst part, the people getting hurt the most by this system are the ones who play by the rules, the ones who pay on time, the ones who stay loyal, the ones who were told from childhood that doing the right thing always pays off in the end. It doesn't. In fact, doing the right thing in the context of modern finance and modern business is quietly, methodically, and deliberately making you poorer every single year. And the companies profiting from your good behavior? They are not hiding it. They have studied it, modeled it, and built entire billion-dollar business strategies around one uncomfortable truth. Your loyalty is their most reliable source of free money. This is the loyalty penalty, and by the time this video ends, you will never look at your insurance bill, your rent, your salary, or your phone plan the same way again. Here is what we are going to uncover. First, why the very financial behaviors that feel safe and responsible are the exact behaviors that cost you the most. Second, the specific industries that have institutionalized the loyalty penalty into their core revenue models. And the actual numbers behind how much it is stealing from you annually. Third, the psychological traps that keep smart, educated people locked inside systems that quietly drain them. And finally, the exact mental shift and tactical moves that allow a small percentage of people to flip this entire dynamic in their favor. Stay with this, because the middle section of this video is where everything you think you know about being a good customer gets completely dismantled. Let's start with a number. 47%. That is the percentage of American consumers who have never switched their home insurance provider, nearly half. And among those who have stayed with the same insurer for more than 5 years, the average overpayment compared to equivalent new customer rates is $1,400 per year. Not across a lifetime. Per year. Every single year that you stay loyal, you are handing that money over voluntarily, and your insurer knows you will. They have the data to prove it. They have built actuarial models around the statistical likelihood that you, specifically you, will not call to renegotiate. They have even given this behavior a name internally. They call it price optimization. You might call it something else. But insurance is just the beginning. This goes far deeper. Think about where you live right now. If you are renting, and in 2024, nearly 36% of American households are, there is a very good chance you are paying what economists now call a tenure premium. That is a polished academic term for a simple, infuriating reality. Long-term tenants frequently pay more per square foot than brand-new tenants in the same building. Studies from the National Bureau of Economic Research have shown that in high-demand urban markets, tenants who renew their leases year after year see cumulative rent increases averaging 3.8% to 5.2% annually, while landlords simultaneously offer new tenant move-in incentives, free first month, reduced deposits, upgraded units, to attract fresh residents. The loyal tenant? They subsidize those incentives. The person who trusted the relationship, who kept the apartment clean, who never complained, who paid on the first of every month without fail. That person is, in economic terms, the worst deal in the building. Now take this same dynamic to your career. There is a phenomenon so well documented in labor economics that it has its own term: wage compression. It describes what happens when external market salaries rise faster than internal employee compensation. When a company needs to fill a role, they pay market rate to attract new talent, sometimes higher than market rate. They budget for it, they fight for it in salary negotiations. Meanwhile, the person already doing that job, the one who knows the systems, trained the new hires, stayed through the hard quarters, gets a 3% merit increase that barely keeps pace with inflation. In 2022, research from Revelio Labs found that employees who changed jobs saw median pay increases of 14.8%. Employees who stayed saw median increases of 5.8%. That gap compounds. Over a decade, the difference between a loyal employee and a strategic job switcher can exceed $400,000 in total compensation. Not a small number, not a rounding error, a generational wealth gap. And you were told that loyalty builds your career. It builds something, just not your bank account. Here is where it gets psychologically interesting. Because the question that demands an answer is not simply, why do companies do this? That part is straightforward. Profit optimization. The more important question is, why do we let them? Why do so many intelligent, financially literate people continue participating in systems that they could, with relative ease, exit or renegotiate? Why does the loyal customer keep being loyal, even after learning the math? The answer is not stupidity. It is not even ignorance entirely. It is something far more powerful and far more deliberately engineered. Inertia, anchoring, loss aversion, and identity. These are not soft concepts. These are measurable, reproducible cognitive patterns that multinational corporations spend millions studying, modeling, and exploiting. When you received your first insurance quote, that number became your anchor. Every renewal that comes in only slightly higher feels acceptable because it is being measured against that anchor, not against the actual market. When your landlord sends the renewal with a $75 increase, your brain immediately calculates the cost and hassle of moving, the time, the deposits, the disruption, and concludes that staying is rational. What your brain fails to calculate, because it was never prompted to, is the cumulative cost of that decision over 3, 5, 10 years. Loss aversion does the rest. The fear of disrupting something stable, even something that is quietly draining you, reliably outweighs the rational calculus of leaving. But there is something even more insidious than the psychology. It is the identity component. Being a loyal customer, a loyal tenant, a loyal employee, these have been framed, culturally and socially, as virtues, as indicators of character. Loyalty is good, leaving is unstable, negotiating is aggressive, asking for the new customer rate is awkward, almost embarrassing. And companies know this. They have studied the social friction around renegotiation, and they rely on it. The awkwardness you feel when you call your cable provider and ask why. Your bill went up $22 without notice? That emotional discomfort is not accidental. It is a feature of the system, not a bug. Now consider the credit card industry. In the United States, the average credit card interest rate as of 2024 sits above 20%, 22%. If you carry a balance, and 49% of American cardholders do, according to the American Bankers Association, you are paying some of the highest legal interest rates available in the consumer finance market. But here is the part that reveals the loyalty penalty in its most naked form. Credit card companies routinely offer balance transfer promotions to new customers with 0% APR for 15 to 21 months. They mail these offers aggressively. They pay for affiliate advertising, targeted digital campaigns, entire marketing ecosystems to acquire new customers at promotional rates. The person they are not offering that deal to? The person who has been with them for 6 years? Never missed a payment, maintained a high credit score, and dutifully paid the minimum every month. That person is too valuable to offer a deal to. Not valuable in the reciprocal sense. Valuable in the extractive sense. They have demonstrated, through their behavioral history, that they will pay whatever rate they are given. Why would the company change that? This is the core logic of the loyalty penalty, and once you see it, you cannot unsee it. But this is where everything changes, because the loyalty penalty is not inevitable. It is a choice, made by companies and enabled by consumers. And the people who understand this do not fight the system emotionally. They do not write angry reviews or feel personally betrayed when their insurer raises their rate. They treat these institutions for exactly what they are, transactional entities optimizing for their own interest. And then they do the same. If you are watching this, and you have ever wondered why your financial life feels like it is running in place despite doing everything right, paying on time, staying consistent, being reliable, this is why. The system does not reward good behavior. It monetizes it. Let us go deeper into the subscription economy, because this is where the loyalty penalty has found its newest and most sophisticated form. Streaming services, gym memberships, software subscriptions, digital news. The subscription economy in the United States alone was valued at over $1.5 trillion in 2023, and it runs almost entirely on a loyalty penalty architecture. The model is simple and brutally effective. Acquire customers at a low introductory price. Gradually increase the price at intervals just below the psychological threshold where most customers will cancel. Rely on the fact that cancellation requires active effort, while staying requires nothing. Research from C+R Research found that the average American underestimates their monthly subscription spending by $133. They think they are spending around $86 per month. The actual average is closer to $219. The gap, that $133, is the loyalty penalty in subscription form. It is the cost of inertia, paid monthly, extracted by services that users sometimes do not even remember subscribing to. Netflix raised prices 7 times between 2014 and 2024. Each increase was announced as modest. Each was met with some subscriber, outrage online, and minimal actual cancellation. Because cancellation requires a decision, and decisions require energy, and the human brain conserves energy by defaulting to the status quo. This is not a flaw in human nature. It is human nature, and it is being harvested at scale. There is a term in behavioral economics, the endowment effect. It describes the human tendency to overvalue what we already possess simply because we possess it. Your cable package, your apartment, your current salary, these feel more valuable than equivalent alternatives, partly because they are yours. The sunk cost of time, history, and familiarity inflates their perceived value in your mind, far beyond their actual market value. Companies do not create the endowment effect, but they absolutely build their pricing models around it. Now let us talk about mortgages, because if there is one domain where the loyalty penalty reaches its most staggering financial scale, it is here. When you take out a mortgage, you are handed an amortization schedule. Most people sign it, file it, and never look at it again. What that schedule shows, if you actually read it, is that in the first years of a 30-year fixed mortgage, the overwhelming majority of every payment goes toward interest, not principal. In year 1 of a $400,000 mortgage at 6.5%, approximately 88 cents of every dollar you pay goes to the lender as interest. That number shifts over time, but slowly. The early years of your mortgage are almost pure profit for the bank. But here is the loyalty penalty dimension that most homeowners miss entirely. Mortgage lenders aggressively market refinancing deals to new customers. They advertise rate drops, cash-out refinances, and streamlined processes to acquire new loan relationships. The homeowner who has been faithfully paying their existing mortgage for 8 years and who is now sitting on significant equity. They are not being called with better rate offers. They are being silently held in a rate environment that may no longer reflect the best available terms in the market. Research from the Urban Institute found that millions of mortgage-eligible homeowners fail to refinance when it would benefit them, leaving an average of $11,500 per household in unrealized savings. Not because they cannot refinance. Because inertia, comfort, and the assumption that their bank would tell them if there was a better option prevented them from ever asking. The bank will not tell you. That is not how the system works. This brings us to what might be the most psychologically loaded aspect of the entire loyalty penalty conversation, the role of trust, and specifically, the way institutional trust is manufactured, monetized, and eventually weaponized against the people who extend it. When you stay with an insurance company for 10 years, you develop something that functions like a relationship. You have spoken to their representatives. You have filed a claim or two. The process worked. You feel known. You feel, and this word is important, safe. That feeling of safety is real. It is not imagined. But it is also not reciprocal. Your insurer does not feel a relationship with you. Their actuarial model has assigned you a behavioral probability score. And that score tells them, with high statistical confidence, that you will not compare quotes this year, that you will accept the renewal, that the relationship you feel is doing precisely what they need it to do, keeping you in place while they adjust the price upward. Trust in a transactional economy is a liability unless it is paired with vigilance. That is not cynicism. That is the operational reality of interacting with publicly traded corporations whose legal obligation is to maximize shareholder return, not customer welfare. Now, let us shift, because the goal of this video is not to make you paranoid or bitter. The goal is to make you calibrated, to replace the emotional framework of loyalty with the strategic framework of leverage. And leverage, real financial leverage, comes from understanding one thing above everything else. Companies do not fear loyal customers, they fear losing them. That distinction sounds small. It is enormous. The moment you become a customer who has demonstrated willingness to leave, not in anger, but in calm, documented preparation, the entire dynamic reverses. Insurance companies have retention departments staffed by people with the explicit authority to offer you rates that their regular pricing team cannot. Landlords facing a vacancy calculate the cost of turning a unit, cleaning, repairs, advertising, the gap period with no rental income, and that cost often runs $3,000 to $8,000. A good tenant asking for a renewal without an increase or even a modest decrease is almost always a better financial outcome for the landlord than the alternative. Your employer, when faced with a resignation, frequently discovers budget for a counteroffer that somehow did not exist during your last performance review. The leverage was always there. You just were not positioned to use it. There is a financial concept called the switching signal. It is the moment you demonstrate, credibly and without hostility, that you have done the research, you know the market, and you are prepared to act. It is not a threat. It is information. And properly delivered, it transforms every negotiation from a defensive conversation into a value conversation. The insurance agent stops talking about your history with the company and starts talking about what they can do to keep your business. The property manager stops talking about market rents and starts talking about avoiding vacancy. The HR director stops talking about budget cycles and starts talking about retention packages. But the switching signal only works when it is real, when you actually have done the research, when you actually are prepared to leave. Half-hearted negotiation signals desperation, not leverage. It makes your position weaker, not stronger. Preparation phase, comparing quotes, understanding market rates, having the alternative documented, is not optional. It is the entire foundation of the strategy. Let us walk through the math of what this looks like executed consistently over 5 years. Insurance, annual review, willingness to switch, average savings of $800 to $1,400 per year. Over 5 years, that is $4,000 to $7,000 returned to you. Rent, one successful negotiation avoiding a 5% increase on a 1,800-month apartment saves $1,080 per year or $50,400 over 5 years. Career, One strategic job change or successfully negotiated offer using competitive data conservatively adds $12,000 to $20,000 annually. Over 5 years, the differential between passive loyalty and strategic movement is $60,000 to $100,000 in total compensation. Credit. Calling your credit card issuer once per year to request a rate reduction, something 57% of cardholders who try it succeed in according to CompareCard's data, saves an average of $300 to $600 annually if you carry any balance. Add those numbers. Be conservative. Over 5 years, a person who actively manages the loyalty penalty dynamic, without doing anything extreme, without taking on any unusual risk, without working harder, can realistically recover $80,000 to $130,000 that would otherwise have been silently transferred to the corporations they were loyal to. That is not a side hustle. That is not an investment strategy. That is simply stopping the leak, and the tools to stop it are embarrassingly accessible. Annual insurance comparison takes 30 minutes on a price comparison site. Lease renewal preparation requires knowing the current vacancy rate in your building's zip code and the average rent for comparable units. 2 searches and 5 minutes. Salary negotiation requires 1 conversation backed by data from Glassdoor, LinkedIn Salary, or Levels.fyi. Credit rate negotiation is 1 phone call. The barrier is not time. The barrier is not knowledge. At this point, it is purely psychology. It is the discomfort of the conversation, the fear of disrupting something stable, the identity investment in being the kind of person who does not make a fuss. Reframe it. You are not making a fuss. You are conducting a business transaction. Every company you interact with is conducting a business transaction with you. They have teams, departments, and entire software platforms dedicated to optimizing that transaction in their favor. Matching that energy is not aggression. It is parity. There is one final dimension to this that almost never gets discussed. And it might be the most important one. The loyalty penalty does not just cost you money, it costs you information. Every year you stay in the same job without exploring the market, you lose calibration on your own market value. Your internal perception of what you are worth drifts further and further from external reality. By the time you finally do go to market, whether by choice or by force, the gap between your expectations and the offers you receive can be disorienting. People who regularly engage with the market, even when they are not actively looking to leave, maintain an accurate, real-time sense of their own value. That information is power, independent of whether they ever actually switch. The same principle applies to housing. The person who knows their rental market, who has browsed listings every few months, who knows what new tenants in their building are paying, who has a clear sense of what their next move looks like, is never trapped. They always have options. Options feel like freedom because they are freedom. Manufactured uncertainty and the fear of the unknown are what keep people locked in arrangements that have long since stopped serving them. This is the final piece of the loyalty penalty that nobody talks about. It is not just financial. It is psychological. It erodes your sense of agency over your own life. The person who has not changed jobs in 9 years, has not shopped their insurance in 6, has not pushed back on a rent increase ever. That person does not just have less money than they should. They often have a diminished sense of what they are allowed to ask for. A contracted sense of what is negotiable in life. And that contraction is perhaps the most expensive thing the loyalty penalty steals. Because a contracted sense of agency does not stay in the financial domain. It bleeds into every decision, every relationship, every moment where the question is, can I ask for more? Should I ask for more? Do I deserve to ask for more? The answer is yes. The data is clear. The framework is available. And the only thing standing between where you are and where you could be is the willingness to treat yourself with the same strategic seriousness that every company you interact with treats itself. You were not told any of this. Not in school. Not by the companies you trusted. Not by the cultural narrative around loyalty and stability and doing the right thing. You were told that good behavior gets rewarded. And in some dimensions of life, it does. But in the financial dimension, in the domain of insurance and rent and salaries and credit and subscriptions, good behavior is not rewarded. It is priced, and the price is extracted quietly, consistently, and indefinitely for as long as you allow it. The companies are not villains. They are rational actors in a system that rewards optimization. The question is whether you are going to be an optimized actor in that same system, or whether you are going to continue being optimized against. That is the loyalty penalty. And now you cannot unsee it. If this video opened your eyes to something you had never quite put into words before, the single best thing you can do right now is subscribe to FinTrove. Every week, we pull back the curtain on the financial systems that shape your life. Not to make you angry, but to make you dangerous. The next video we have coming is on a related concept. Why the people who seem to make the least financial effort often end up with the most financial freedom, and the specific mental frameworks behind how they think. You are going to want to see that one, subscribe, and do not miss it. The game was always rigged in favor of the people who understood the rules. Now you understand them too.